Okay, hello everybody. Welcome to Korean Atlanta Mentorship. So we're just going to do another Velocity Banking review for today, this time with negative cash flow. Okay, so let's say you make good income and you have a lot of expenses because of you have a lot of debt, right? So a lot of people, if they were in this situation where they had 10 credit cards equaling to $167,000, they would freak out. Okay, and in this situation, we're going to have 100 negative $144 in our savings. And you know what happens when you have negative savings, right? You're essentially a money maker for the bank because I don't know if you knew this or not. Banks pull in a lot of money from overdraft fees. So if you have negative savings and you pulled out way too much money from your bank account, they actually like that because they get to charge you money. And it says right here on money.com, despite recent industry reforms, banks are still pulling in between 9 to 10 billion per year from people who overdraw their accounts. It's just for profit. They're penalizing you for being poor. Now, in this case, we're not actually poor because we make a lot of money, yet we're still negative, and this actually happens to a lot of people. I've seen this with a lot of times with people randomly emailing me their spreadsheets saying, "Oh my goodness, I'm screwed," and usually they're not at this situation. Like they make good money, maybe six figures, and they have like $700 a month in savings, which is better than negative 144, and they think it's the end of the world. But here's the thing, with a lot of people, when they just make more money, they just spend more, and that's why their spending habits get out of control. So what we're going to do is just a quick demo of Velocity Banking and use it to learn how to manage our cash flow so that we can turn this negative into a positive. Okay, and so let's just assume that we have access to something called a line of credit. And actually, so let me just go over this. So what is Velocity Banking? All Velocity Banking is a debt payout strategy using a line of credit as your main operating account. Okay. Now, we only need two things. Number one is the budget, right? So we have our income, expenses, leftover savings, and this is the traditional average American. And what do we mean by a traditional average American versus Velocity Banker? It just means someone who uses their checking account as their main operating account. And then right here, the Velocity Banker uses the line of credit, a line of credit as their main operating account. And I know there are some of you out there who have no idea what a line of credit is. All it is a financial tool where you could borrow money, pay it back, and use it over and over again, right? So a credit card's a line of credit. There's actually tools with the name line of credit in it, so personal or home equity. And I have all of them. Again, so some of you who've watched these videos already probably know I have over $279,000 in lines of credit. And the best time to get it is when you don't need it, right? So some of this will be unrealistic because, people watch these videos and they're already broke and it's like, well, how do you get a line of credit? My answer is you can't because, and again, there's probably some exceptions to this, right? I'm not saying I know everything, but you want to have good foundations. So as a general rule, I'm going to tell myself if I want to get more credit, I need to get it when I don't need it. Right? I don't want to get credit when I need it because even if I could get it, I'm essentially not fixing the holes in my what do you call it, foundation. I don't know if that's the right way to say it, but you really want to get credit when you don't need it. Okay. All right. So now, so we've done the budget. Okay. And what's really important when we do the budget is we have our expense breakdown, and in our expense breakdown, we list every single debt that we have because the purpose of this strategy is to pay off debt, and the more debt we pay off, the more cash flow we get. And then there's always this other section right here, which is our fixed expenses. So food, gas, insurance, all the other good stuff that you're always going to have to pay every single month, right? Like we always make sure that we're going to have to pay for these. But all these other debts that we have, we can make go away and increase our cash flow, right? So what we're going to assume is we're going to have access to a line of credit. So we're going to have access to a huge one. So we'll say we have a $200,000 line of credit. Think of it as almost like a $200,000 credit card, right? So the easiest way to get a line of credit is offer collateral. And so if you offer your home equity as collateral, you could get lower rates and bigger limits. So that's why home equity lines of credit are popular. The only issue is that a lot of people use them wrong. And I've done demonstrations dissecting Reddit posts about how people are getting HELOCs and struggling. And I'll tell you why they're struggling. So let's say we had a $200,000 line available, and let's say we had a $1,000 emergency, okay? I don't know about your home equity line of credit, but mine says that if it's above $50, that the minimum payment will be $50 or 2% of the balance, whatever's higher. So we're just going to see, okay, we have a $50 payment that we have to make, and so we're in debt. Oh my goodness, we had $1,000 emergency. I don't know, your car broke down, and everybody hates it when their car breaks down because it's like thousands of dollars that they're out and they can't even go to work and make money. All that bad stuff happens, right? But let's say we had $1,000 emergency with a $200,000 line of credit available. So if we do things that the average American does it, right, the average American way, well, guess what? We're just going to sink deeper into the hole, right? So if this is a negative 50, now it's more overdraft fees, right? So we're just going more in the hole if we just have a line of credit and use it the average American way by still using our checking account as our main operating account, right? So using this as a backup in case of emergencies is no bueno. We're not going to do that, okay? We're going to make this our main operating account. So B2 minus B3. And so what we're going to do when we do velocity banking is we're going to assume the same income, and we're actually going to go from negative to zero, right? We always go to zero with velocity banking. You know how Dave Ramsey teaches you got to save $1,000? Well, we're certainly not going to save $1,000 here. We've disproved in other videos that we shouldn't do that. And he calls you a beginner for saving $1,000. What we're going to do is make sure this goes to zero, but we're going to have something called cash flow. Okay, so let's go ahead and copy these expenses. And then what we're going to do, the cash flow will be income minus our expenses. Now, right now, this cash flow and savings looks exactly the same, right? But that's because we haven't made our line of credit as our main operating account. And you might be asking, how do we do that? Well, the actual strategy itself is that once we made this our main operating account, we're going to dump our entire paycheck, the entire $9,500 into that line of credit. And then we're going to take our expenses out, and that line of credit will go down by our cash flow. So how do we do that? Well, let's go ahead and transfer some debt. And the easiest debt that we can transfer into the line of credit is credit cards, right? Credit cards have the highest interest rate, and they take up the most amount of cash flow out of any loan or out of any debt product. So let's go ahead and move all of this just to show this demonstration how we can go from negative to positive. So if we add this up, it's $167,000, right? $167,000 into this home equity line of credit. And guess what happens just by simply doing a debt transfer? Okay, well, this goes to zero. This goes to zero. All these payments go to zero, right? 8, 9, 10. So all these 10 credit card payments go to zero. And guess what? We turn this negative cash flow into $5,201 of cash flow. Isn't that crazy? Like we were struggling. We were on the struggle bus here, and we thought, hey, if we had a HELOC but still do it the average American way, we'll be okay. Nope, we are not, because we are not making our line of credit as our main operating account, which is why even if we have borrow money in emergencies with our line of credit, we're going to be more in the negative if we do it the average American way by making our checking account as our main operating account. But when we do things the velocity banking way, oh my goodness, we basically went from negative to positive in an instant, and here we're in the struggle bus, here we're in the party bus, right? So we don't want to be in the struggle bus, and usually when we are in the struggle bus, the bank is in the party bus, okay? So let's go ahead and do this. We're going to dump this 9,500 into this balance of 167, take out 4,200 or $300 in our expenses, and after every single month, our cash flow is going to bring down the balance of this line of credit by $5,200. Okay, and so all we got to do is just write some formulas to show how long it's going to take, right? And what we do is we take the previous month's balance plus the previous month's interest to get the next month's balance, and we minus it by our cash flow, which is 5,201.35, right? And then in order to calculate the interest, we take the average of daily balance, so we get the average of these two numbers to estimate that, and then we multiply it by 10%, right? Because that's the interest rate right here. That's actually the interest rate of my current HELOC. Probably in a couple months, I'm going to get a new HELOC, and it'll probably be 8.5% because I'm going to do it through a credit union, because credit unions usually have cheaper debt products than banks. So, but it's not going to be that much cheaper, but 8.5 is still better than 10. And then you divide by 12, okay? So now we have the interest, and then you can see after every single month that the balance will go down by the full power of your paycheck, because when you put that entire paycheck into that line of credit, it does two things. It satisfies the minimum monthly payment, so that payment don't even matter anymore. And then number two, it's going to minimize this interest. And there are even better ways, or not better ways, more ways to minimize this interest. But and I'll briefly go into that. So if you want to know how to minimize this number, one way you could possibly do it is by still using this credit cards, okay? But using it up to $2,500, which is your general expenses, because the beauty of credit cards is that you have a 1 month float period, meaning just as long as you pay them off at the end of the statement period, the statement balance, they don't charge you interest, so it's like potentially delaying the interest for a month, right? So that's one way you can make this number go down, okay? So let's go ahead and copy and paste and figure out up to what point, right, that this is all going to be paid off, right? So in 38 months, so let's just go ahead and highlight that. And how many years is that? So 38 divided by 12, let's go ahead and calculate that. So that's going to be 3.16 years, right? So that's not bad. I mean, we had $167,000 of debt, and we started off in a negative cash flow situation, okay? Negative cash flow, right? So now let's go ahead and write this down right here. So 3.16 years to pay off 167K of debt, right? 167K of debt. And we're going to go ahead and write that for all of our credit cards, right? So our 10 credit cards. Whoopsie, why did I do this? Okay, now the next one is our mortgage, right? So now what we can do, and it's up to you, right? So if you want to put your entire savings, because this will just now go into our savings because we don't have to, well, we could, right? So this is what I'm talking about. And let me, I know my thoughts are all over the place, but we could do two things. We can put this $5,201, which would eventually stay in our checking or savings, and directly dump it into our loan, or we could put it in our line of credit, right? Either way is fine. But I know just from human behavior and statistics that most people never overpay loans. And why do most people never overpay loans? Because once you dump that $5,201 in, you can never pull it out, right? And then there's this phenomenon called segregation of income that we can prevent, which I won't go into too much in this video, that we can prevent if we move parts of the principal to the line of credit, okay? So let's say that we move the equivalent of, I don't know, our paycheck, or we just do $10,000 into that line of credit. So this will be $290. So we essentially borrow $10,000 from the line of credit, pay off the principal, and then now we dump our entire paycheck into the line of credit. So how does that look? Well, basically we add 10,000 right here, 10,000, okay? And then you'll see in like 2 months it gets paid off, right? 2 months, oh my goodness. And that's because we have so much cash flow. But but most people, you could do it either way, directly dump your cash into the loan, but most people will never do that, because if they did do that, then the average person would pay off their mortgage in 7 years and not have it, they wouldn't refinance when they get a letter from the bank. So I don't know if you know this or not, but the average person refinances every 5 to 7 years, or they sell their home. So their 30-year loan essentially becomes, after selling or refinance, it becomes a 52-year loan. So most people just never pay it off, right? So luckily, we have a Velocity Banking calculator to kind of for us to determine with the amortized loan or with the 30-year mortgage how long it's going to take to pay this off. So let's just go to loan amortization calculator and look at, after 3.16 years, how long is it going to, what is the current balance of the loan, and then just copy and paste these numbers to our Velocity Banking calculator, okay? So let me just go here and go to loan amortization calculator, and there's a cool website for that, and we just got to input the numbers. So 300,000, right? So not 30,000, 30 years, and was it at 6%? Yeah, it's at 6%. And the reason that we have to pay this off quickly is because if you just go to the full 30-year term, you actually pay 54% in interest. So 46% of what you pay in total is the actual $300,000 loan itself, and you pay more in interest than you do pay on the loan. I don't know if you knew that, but once I found that out, I was like really shocked. I was like, "Oh my goodness, I do need to pay this off quickly." So let's go here at how many months this was at. This was at 38 months, so 38 months. And then right now it's after year, a little bit after year 3, so it's year 3 and 2 months. So 287,000, that's the current balance of the loan, right? So that's the current balance of the loan, okay? And so now, okay, so if we, either way is fine, but I would do it in the, my preference is just to do it with the line of credit because it's easier to put your paycheck into one place, right? And you'll pay it off pretty quickly or just as quickly, right? So let me go in here and just put it in this Velocity Banking calculator of what the payoff date would be, right? And let me just go in here. Okay, and if you ever want to know where I got this from, I got this from Renatus, and this is where I originally learned Velocity Banking from in 2017. In full disclosure, I actually sell their education and make money off of it. So some people have been asking me about it, and I'm really curious. Like, I've actually had 2 people sign up from here for it, but I'm actually kind of curious if when more people will sign up, just because I think it provides a lot of benefit, or at least to me it did. I mean, I got a house at $100,000 discount and learned that from Renatus as well. But enough of me blabbering, so let's go ahead and put that information. So let's do this, 300,000, 300,000, that's the original balance. And then the current balance is 287, and then the payment amount is 1798.65. So we're going to put that right here, right? I think I got to take, okay, 1798.65. All right, excellent. And then what's our monthly income? Our monthly income is 9,500, which is, most people would never experience that just because, you know, like the average, I think, what's the average American salary? I think household income is like 75 grand. And this, I think, is like, this is probably way more than that. But I got to figure out how much income this is on before tax basis. But again, so let's put in our expenses, and our expenses, everything except for the loan we're trying to pay off. So we'll just put in 2,500 right here. Okay, and as you can see here, it pays off about 3.9 years. 3.9 years. We paid 35 grand. Okay, so even if it's a 10% interest rate, you'll still have an accelerated payoff, because what's more important is the cash flow number. So let's say, like, oh, we use a credit card. We'll probably pay like a couple more grand. So let's say it's 30% credit card. Okay, we pay 6 more grand. But again, sometimes, you might ask, like, why would I want a credit card to do this? Because there's a saying that says that the best credit decision is not the best financial decision. So if you're just trying to expand your credit base, well, you got to pay a little bit of interest, right? You got to use the card a little bit. And so, and also they give you rewards points and stuff too. So you might be able to kind of do some arbitrage, credit card arbitrage. If you have no idea, look it up. Use your credit card, and so you might have like a $10,000 card, and then next thing you know, because you're using this method, it's going to be a $40,000 card because you use it so much. And so you might want to think about that, even though you pay more with the 30% credit card, right? But so okay, so let's go ahead, and I just want to demonstrate one other thing. So what if we replaced our mortgage with a 10% line of credit? You'll notice that this doubles, right? So isn't that crazy? So and this is why I say one of the most important things that you're going to learn here is that 9 times out of 10, you don't want to replace your mortgage with a first position line of credit, because you'll end up paying more unnecessarily, right? So this is why the chunking method is powerful, meaning that you just incrementally move portions of the principal to the line of credit and then pay it off with the cash flow. So if I do $10,000 here, so right now you notice it's 66,000, and then we kind of like have that almost, right? By basically not replacing our mortgage with the line of credit. And I could probably do another video on this about why um, most people should not get a first lien HELOC. Like you should only get a first lien HELOC, in my opinion, after you've paid off the mortgage, not as a way to pay off your mortgage because you're just going to double the interest that you pay. Let me just show you one more time, okay? Right here, 66 grand. If we do $10,000 chunks, 35 grand, right? If we do a 30% credit card with that chunking method, we still pay a lot less, right? We pay 41 grand. Okay, so I don't know what about you. Do you want to pay 65 or 66, or do you want to pay 30 something grand, like half of that, or even with the 30% credit card, you'll still come out on top than replacing your entire mortgage with the line of credit. You don't want to do that. You might hear that from the internet sometimes. But all right, so now we have 3.9 years. 3.9 years. So let's go ahead and do this. So 3.16 plus 3.9. And then now in 7.06 years, we are completely debt-free, 467K. Woohoo, right? So 7-year payoff. So it took us about 3 years to pay off all this credit card debt and then another 3 years to pay off this mortgage, and we are completely debt-free. And now we have something called rich people problems. And once we're in rich people problems, man, if you've never dealt with rich people with a lot of money in their checking account, they're always anxious because there's like, I always want to invest it, right? Because they want to beat inflation. Because they know that when they have a lot of money in a checking account, it's just kind of their buying power is kind of disappearing, and they got to spend it or invest it, right? Invest it. They want to. I want you to get to a point where you got rich people problems, right? You might be in this situation right now, but I know when you focus on paying off your debt, one day you'll be right here and you could proudly say, I got rich people problems. Okay? That I gotta make a t-shirt for that. I got rich people problems. All right. Well, that's it for today, everybody. This is Korean Atlanta Mentorship. Again, how do we get from negative cash flow to positive? Well, at least in this scenario, using our line of credit as our main operating account on day one and doing something called velocity banking. Have a great day, everybody, and good night.